This is the greatest mutual fund of all time. What do you think it is? You want to take a guess? All right, so hang in there with me. You got to watch the whole video to find out. Now, I'll share with it right now. It's the Vanguard S&P 500 Index, VFINX. By far and away, the greatest mutual fund of all time. Nothing beats it. Nothing has done more for the average investor than VFINX. We're going to dive into it here a little bit as well for performance and all that. But let's scroll back in history, shall we? And we remember our book, Common Sense on Mutual Funds by John Bogle. And back in the old days, the average Joe could not invest. They just could not. I mean, they might have had a couple of shares of this stock or that stock, and that's it. The commissions were regulated. There's a flat or a fixed fee you got to pay for commissions. And so the average investor could not, basically was out of the out of the industry. On top of that, the few funds that were available, usually like an 8.5% sales charge back then with horrific fees. It was insane. It was insane. And so not only was the average investor unable to afford the ability to buy stock because the commissions were so high, to buy mutual funds was 8.5% commission, 1%, 1.5%, 2% fee annually. It was just nuts, man. And then come along this scraggly, hard scrabble guy from Princeton named Jack Bogle. Jack said, "This is nuts. These fees are destroying people's investment returns because they're basically is a reverse Robin Hood. It's taken from the poor and given to the rich. And so I'm going to create this fund which just marks the market. That's it. Tracks the market. Doesn't do better. Doesn't do worse. Well, actually, it will always do worse. Always. VFINX. The reason it will always do better is simple. The market gives you 8. VFINX will give you 8 minus the tiny fee they charge. I think it's 14 basis points right now. So it'll give you 7.86. Market gives you 20. It'll give you 19.86. The market is down 20. It'll be down 20.14. It'll always underperform the market. I don't care what I'm doing relative to the market. I care what I'm doing relative to my peers. Frankly, I don't even care all that much what I'm doing relative to my peers. But while it underperforms the market, it outperforms the vast majority of its peers because the peers end up paying fees extraordinarily high, which even if they're great money managers, the fees they charge are taking away your ability to outperform. It's just basic math, my friends. And I'm not going to get into it too much here today because I've done it before. But let's dive into the track record of VFINX. So first thing we're going to do is go to Morningstar, 4-star rated. Now, there are 5 stars. And I've done one of my first blog posts ever I did on Morningstar, why you should look at fund star ratings, for sure. In the old days, not so much. Nowadays, you should, though. And the reason is because you always see this quite a high correlation between low expense ratios and high ratings, almost across the board. It's nuts. And so if you're paying for if you're getting a high rated fund, a 3, 4, or 5, inherently is probably going to have low expense, which means it's most likely going to maintain itself in 3, 4, or 5 category. So here's VFINX. Inception, I think in 1974, 72 or something. Let's see what it shows us here. I can't remember. We'll find out. And so what you'll see here is here's the, again, since the growth of 10,000, since over the last 10 years, the index itself has grown 10,000 has grown to 42,000, where the VFINX has grown to basically 41 because of this tiny fraction of the fee in there. The category has only grown to 33,500. So smoke the category, and the category is going to be a large cap blend, I think. Let's see if it shows us here. Yeah, large blend, exactly. All right, right there, large blend. Turnover is only 4%, which we'll dive into here in just a second. That's huge, my friends, huge. All right, so let's keep going. So we got low turnover, low fees. It just mimics the market. It'll always underperform the market. 2010 is in 31% percentile. 2011, you can see 19, 38, 40, 20, 22, 29, 33. You see something here, a consistency in the top third of its fund peers, year in, year out, top third. Because a fund peer, this is net of fees. It's crazy. So let's go. Let's see what we got here. I don't know if we can get the free where they show us taxes. Yeah, I hate these P's. process, people, parent, price, performance, portfolio. I hate that crap. I can't. There used to be. Let's see if we got on. Yeah, okay. I'm not a premium member. All right, so let's go to VFINX, and we're going to go to performance. And I think 1973 is, I think, the inception. Let's see here. Let's go now. Doesn't kind of, let's see. Summary. I'm almost positive 1976. 1976. Okay, cool. So let's see here. Let's just go back to performance. And we're just going to go year over year. All right, so here's the category. Here's a VFINX. The category, again, is, does it say here? I'm sure they say large blend as well. I'm sure they're just getting off a Morningstar. Doesn't say the category. Right there, large blend. Okay, cool. So let's go down to performance large blend, and we'll see. So here's right here, beat the category, 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 beat, lost, beat, lost, beat, lost, beat, lost, beat. Yeah, you see where I'm going here, right? Beat, lost, beat, lost, beat, lost, beat, lost. So you can see where I was going there. So, hold on a sec. So smoke the category of large blend. It just, so if you're buying a large cap blend fund and you don't buy the S&P 500, I don't know what you're doing. It doesn't make any sense. All right, so I don't think they show tax efficiencies here, but we're going to go into it. Let's see. Is risk? I don't think they show risk on this. Yeah, well, we got 43 years, 35 are up, 8 were down. The best year was, the worst year was in, that doesn't make sense. Best 1 year return, that doesn't make sense. But it's 37%, it was down in 2008. Top to bottom is 54% down from October 2007 to March 2009. I don't care about any of these numbers. That doesn't mean anything. I mean, people will say it means something. It doesn't. Holdings. Let's see what else I want to show you here. Let's go to historical data. Yeah. All right. So what I want to do now, I want to go to the prospectus itself. Hold on just a second. Seeing that the performance has smoked these other funds by and large. I mean, it's not really debatable to me, but be it as it may, there's more to that than just performance. We also have to look at taxes as well. So if we look at the S&P 500, the Vanguard S&P 500 index, this is VFINX, the prospectus. We're going to show you. We're going to go down to here. Let's see here. Hold on just a second. All right, hold on, pause it. All right, so this is what matters. Average annual returns before taxes, returns after taxes on distributions. That'd be capital gains and income distributions. After taxes and distribution of sale of shares. So not only do you have to pay capital gain income tax, hey, buddy, you got to pay Paul the like button because Pablo's here. There he is. You got to pay taxes on the fund, the stocks that you sell, the positions that you sell. So, 10 years. S&P 500 right here is averaged 13.5%. Returns off after taxes on distributions, 13.04%. Returns on after taxes and on distributions and sale of shares. And I want to write this down, so hold on just a second so we can look at something else. 11.26%. So taxes cost, right there, 13.52, 13.04, and then 11.26, and that's for 10 years, all right? So we lost 225 basis points, basically, 2.25% from having to sell the shares, all right? Now just keep watching here for just a second. That's now the S&P 500 itself was 13.56%. So in the Admiral shares, it matched the S&P 500 except for 4 basis points, 0.04% because of the fees. This is on Admiral shares. So you can see the taxes that the S&P 500 gave you is only 13.04. Is only less than half a percentage point because of capital gains distributions. Now let's find an actively traded mutual fund. So hold on just a second. So here's a Fidelity Magellan, which is, well, Peter Lynch used to run this. I have the book, One Up on Wall Street, back there from 1993 or something like that, which I bought it. But here's an example. So here we have past 10 years is 12%. Returns after taxes on distributions. Look at that. Look at that, man. 1.8% difference. The return on taxes after distributions. Now, returns after taxes on sale of shares is 9.52. But ideally, we're not selling our shares, right? We're not selling our shares. We're just paying the tax on the capital gains that you have and the long-term capital gains and the return on the income that you receive. Look at that. That's 1.8%. Even by holding the portfolio, you're losing to taxes. Now, this is the highest tax bracket. I get all that. There's all these prospectuses show if you're in the highest tax bracket, the short-term capital gains. But it's not even debatable. So Vanguard, it charges you 0.48%, 0.5% for 10 years. Fidelity Magellan charges you 1.8% for 10 years. It's nuts. And then, of course, Fidelity Magellan only gave you 12% gross rate of return, where the S&P 500 is 13.56. Vanguard S&P 500 gave you 13.52. It's just not even close. So we'll look at a different one. And by the way, I forgot to add, Fidelity Magellan was the where we used to be with mutual funds. Most mutual funds used to be just like Fidelity Magellan, high cost, high turnover. Back they probably didn't have that much turnover back then, but nowadays they are high cost, high turnover, and middling performance. And again, it was 8.5% front-end commission. This has a turnover of so here's the fee, 0.77, and the turnover is like 75 or 50% or something like that. Let's see if I can find it. I saw it in here. I'm not going to be able to remember it. Yeah, it's in here anyway. But so they have a high cost, high turnover, and essentially they're going to be a lacking fund. No other way around that. All right, let's stop for a second. The Fidelity Contra Fund, and I've been a big fan of the Contra Fund for a long time. Bill Danoff run. I don't know if he still does or not, but we can look. And it's done very, very well, the Contra Fund. All right, but again, fees are 0.85. You're paying 0.71 in management fees and 0.14 in other fees. And these are, again, no load funds, by the way. We don't even have a 12B1 fee in there. So I'm not sure what the Contra Fund, the other fees are to print the statements off. But anyway, so let's see what we got here. So we're going to go down. And I think Contra Fund's large cap growth fund. Here's return before taxes, 13.96. Vanguard's was 13.52. Return after taxes on distributions. Again, this is just the income they get from capital gains and dividends. And because it's Danoff, been running the portfolio since 1990, because it does a lot of trading, the taxes take away more. The returns, about 1.2%, where and so it loses to S&P 500, because S&P 500 after taxes on distributions is 13.04. So this smoked the S&P 500 before taxes. After taxes, it got smoked by the S&P 500. That's just all there is to it. Now, if you had to sell your shares, you did better in this fund, but not by much, 11.44 to 11.26. I mean, literally, it's just, let's see what this looks like on Morningstar. So let's close out this. We're gonna go to let's go to Yahoo. Here we go. Go to Yahoo Finance. And we'll put this guy in here. And we'll see what we come up with. Contra Fund. There we go. All right, so let's see. Large growth. There you go. 3 stars. Turnover is not as high as I would have thought, 26%. But this fund's been around since 1967. All right. And we go to perform. And again, I don't have any qualm with this fund, but I mean, just man. So if we look at its relative its category under. Oh no, I'm sorry. Under, over, under, over, under, over. You see, but the issue is they're not. It's like it's more hit and miss. Sometimes they kick butt and take names. Other times they just don't. And then you have the fees thrown on there, and that's before taxes. And with the taxes, they don't. So anyway, the issue here is that people all day long, and they'll say, well, if I'm in an IRA, then I don't have to worry about the taxes on distributions. No, you don't. Absolutely. Yeah, I mean, literally, you do not have to worry about taxes on distributions. I get that. But you can see even the contra fund did just a little bit better than S&P 500, 13.96 to 13.52. And what's the staying power of the contra fund relative to the S&P 500? Well, I mean, at the end of the day, Bill Danoff has been running the fund for 30 years. How much longer can he do that? Will his protege be the same? If we look at Fidelity Magellan, went to Jeff Vinnick, then it went to drawing the other guy, and they just never performed the same way Contra Fund did, Magellan did. With the S&P 500, you don't have to worry about all that. So every single stretch of any argument you can make, the S&P 500 is the best fund out there. Tax efficiency, turnover efficiency, expense efficiency. It's just not, I mean, and then quality of performance relative to his peers, gross and net. It's just you cannot find a better fund that will be in the top percentile year over year over year. I mean, you just can't. And the reason for that is simple, because it doesn't have much turnover, it doesn't have much fees, and it doesn't take a position on the market. Just I'm matching the market. That's it. And if you are trying to beat the market, that is not your fund. But if you beat the market, it means someone has to lose. And when you factor in those fees, the whole shift goes that way, because the fees will make more losers relative to the market than winners. It is not a freaking fixed issue. You can't have 50% beat the market, 50% lose the market when you factor in fees. Inherently, you have 25% of the people beat the market, 75% of the people lose simply because of the fees. Anyway, that is the best fund. It's done so much for regular investors. Nothing has come close. It's just the best fund there is. No other way around that. Love to hear your comments. All right, we'll see you.